as they trickle in. The first flash will be on your screens in just a moment. Remember, in terms of revenues, we're expecting a 3% mop up. For net profit, we're seeing a growth of about 2.5%. That is what is expected from HCL Tech. Now, if they can do an encore of what TCS and Infosys have done in terms of guiding to the market that the business environment is changing, it's looking up. The optimism is coming back for the sector, and that will be encouraging to see as well. But we are expecting revenues to grow at 2% quarter on quarter in constant currency terms. The cross-currency impact will be about 120 basis points. And of course, we expect pickup across the board. So 19.5 to 19.7, anywhere around the 20% mark in terms of margin performance, that would be seen as a good show for HCL Tech. But let's just get the numbers going on screen. If we could do that. Apologies for that flash, but we're going to get the numbers on your screen in just a moment. We're expecting a profit figure of 2250 for HCL Tech. And we are expecting almost $2 billion in revenues for this quarter. We'll just come up with the number on the earnings, but that's the number that we need to focus on, 2250 crores on profits. Okay, revenue growth seen at 9.5 to 11.5%, bang in line with estimates. This is exactly the range that the market was going with. Expect company to guide for 9.5 to 11.5 dollar revenue growth for FY19, along with stable margins. Let's see what they deliver on the stable margins. And their early numbers will be important, but I think Sunita joins in with a detailed check of those numbers. Sunita, could you run us through the top line, bottom line performance? I think what would impress the street is that they've maintained the street expectations on the guidance front.
Absolutely, the expectations on the guidance front has been met. If you see that they have guided for 9.5 to 11.5% growth in constant currency term for FY19, and they are saying on the margin front that they are maintaining 19.2 to 20.5. If you have remember that in case of Infosys, we saw that although the top line margin was in line with expectations, they had reduced the margin guidance lower, which was not taken very positively by the market. But in their case, they are maintaining that the margins will be maintained at 19.5 to 20.5. Guidance for in constant currency is 9.5 to 11.5. In dollar terms, they will grow 10.5 to 12.5, which is more or less in line with what the street was expecting them to guide. So numbers on the guidance front are meeting expectation. If you look at, they normally only give mode 1, mode 2, mode 2 or mode 3 only at the end of the year. So they have given that split for their performance. Mode 1 has grown in FY18 at 5.7%, which is essentially the 80% of their revenue, which is the traditional side of the business. Mode 2 has grown at 29.4%, and Mode 3, which is basically products business, is grown at 68.3%. So clearly there is a shift happening from the traditional side of the business to the newer technologies, which is Mode 2 and Mode 3. They have maintained that the Mode 2 and Mode 3 will be growing at much higher pace and going forward. So that's exactly how it is panning out. If you look at the current fiscal's revenue, they have their revenues have crossed the 50,000 mark for FY18. For the quarterly, they have crossed the $2 billion milestone. So numbers as far as the Q4 performance or the FY18 performance is concerned is in line with expectation, but it's basically the guidance which should get the thumbs up from the analyst community.
Sunita, just one very quick follow-up question. Now HCL Tech, when we met them in Noida last, that was in the month of Jan, they were sounding optimistic and others were not sounding all that optimistic. Now others are sounding optimistic and HCL Tech should be sounding extra optimistic. I mean, that's the way I look at things. When you were optimistic when others were slightly subdued, then when others are excited, then that time you should be extra bullish.
Absolutely, they have been doing well, largely because their inorganic growth is also contributing. Their IP-led acquisitions have helped them acquire growth, going to that's how they've been growing. They have been doing not so well on IMS business, which is essentially accounts for 36% of their revenues. But they have been saying they are expecting a pickup in IMS business. They had initially said that they are expecting that to pick up in Q1. but there is an expectation that it might be pushed back by one more quarter. So there is a chance that the IMS, which has not done so well in FY18, might do better in FY19. So that is the expectation analysts have. We'll have to wait for the management commentary how they are expecting IMS business to grow. Mode 2 and Mode 3, as I mentioned, are the higher growth services that they are seeing growth, that they have been bagging good deals in that segment. And if you, as you saw in Q3, that the deal wins have been the strongest in Q3. We'll have to wait and see how they performed as far as Q4 is concerned. But the deal wins have been a strong point for them. IMS has helped them get into boardrooms. They have started to give higher services for those the same clients. So this is how essentially they are moving up the chain. As far as the margins are concerned, although the margins are improving, but they are reinvesting those margins to get the technology-wise some upgrades so that they can offer their clients better services, more up-to-date business that they can offer to their clients. That's how they have been progressing so far.
Yeah, indeed. In fact, let's take that conversation forward with Urmil Shah, research analyst, institutional equities at IDBI Capital as well. Urmil, on expected lines, HCL's performance, can the stock push up higher?
So actually, the Q4 growth has come a percentage points lower than what we were expecting. We were penciling in a 3.4% QOQ growth. As well as the guidance given the acquisition which they have announced of Accent Corporation, we were expecting that the guidance should have come at between 11 and 13% in CC terms. So need to understand if they have factored this acquisition in this or not. So if it is factored in, then clearly the guidance is slightly lower. More or less, IMS coming back to growth or 2.5% growth in this quarter is a positive. This has been one vertical which needs to fight HCL Tech, going into FY19.
So in the pecking order, Urmil, post HCL Tech's numbers and the guidance given out, what would your order of preference be within the IT pack now that Infy, TCS as well as HCL Tech, the market knows those numbers?
So HCL Tech and TCS are the only two companies which we expect to deliver double-digit growth in FY19. HCL Tech is trading at about 13 times on FY20 earning, so it remains attractive from valuation front as well. That's why it's at the top of the pecking order. So it's HCL Tech, TCS, Infy, and then Wipro.
Urmil, good speaking with you. Thanks much for analyzing as to what you made.